Hey everyone, welcome back to Yuri's Box. In this video, I'm going to talk about the S&P 500 as well as a quick look at things like TLT. If you like this kind of content, consider leaving a like. And as usual, nothing I say in this video is financial advice. So this week we had really a deluge of data come out, and kind of had the most important data sets come out yesterday and the day before in the form of CPI and PPI. Now, both readings came out much cooler than the market was expecting, and but really things like the bond market really didn't have much of a positive um, answer to a reaction really to this cooler data. And the reason why is that what the bond market is really doing is it's extrapolating the fact that we might have a possibly hotter uh, PCE reading at the end of the month. And the reason for that is similarly to what happened last month, where PPI came in hotter, but the components pointed towards a cooler reading in PCE. We're kind of having a bit of the opposite reaction to it now. PCE came in cooler, but some of the components seem to point towards a hotter PCE print at the end of the month. So that's kind of what is happening with the bond market as things are right now. Now, a cooler PCE isn't something I'm particularly surprised about. And the reason why is in my previous videos, I've pointed out many times how from the fall to more or less the January to March time frame, you usually do get a bump in inflation where it stays sticky and seems to be a bit pointing towards the upside again. However, I've said again in my videos that this is usually, to use a very unpopular word, transitory, for the simple reason that that time frame is where people travel more, people spend more because of the holiday season. It's a time of the year where usually people get their bonuses, the end of year bonuses. And again, if you're going to feel upbeat about things in general, that's going to be from, say, the end of the year. So from September to October till March, okay? Then you usually get back to business, to whatever the previous trend was. And like in 2023, we had exactly that. You look at 2023, you had inflation kind of bottom out at, 3.1, okay? And it kind of stayed sticky until March, where it peaked out at 3.5, and then it resumed its previous downward trend. And I also like to add context by looking at the quits rate. Okay, so whenever you see the quits rate stay steady, that is usually it's an indication of the fact that you're probably going to see inflation stay sticky as well, for the simple reason that if people are feeling more upbeat about things and so they're quitting their jobs because they think that they're a bit more optimistic about the economy in general. Again, positive a positive feeling about how things are going will lead to more spending. Okay, so I've pointed this correlation out in my previous videos. How, again, if you whenever you see the quits rate kind of stall out, you see inflation stall out at the same time. And whenever you see the quits rate pick up, that is generally when you see inflation have kind of a hiccup. But again, as I said before, ever since March, it kind of started rolling back over. Now, if you really wanted to get specific, we had the last print in the quits rate come in at 2.1, which is a 0.2% increase from December's number. Sure enough, it was consistent with with the print with inflation coming in higher in January. Now this isn't updated to reflect the latest inflation number, I think. Okay, here we are. I don't know why that wasn't. Okay, now it's showing it correctly. But in any case, next month's quits number could very easily come in at a lower number, lower print. But in general, I'm not so worried about, where the quits rate is. What matter, I mean, short-term fluctuations. What matters with the quits rate is the level it is, okay? Whenever you see the quits rate at cycle lows, it is an indication that people aren't feeling as confident about the economy, meaning that while you're up at cycle highs in the quits rate, that means that people see abundance in the economy. And when they see abundance, they feel like, well, they really have the leverage in the labor market, okay? Meaning that if you know that there's a lot of jobs that you can switch to, that alone will be a reason to go to your employer and ask for a raise. And so you have that feedback loop where, higher wages feeds into higher consumption, and, it is supportive of higher inflation overall. I've also made the case that we are no longer in that state of the economy where you have, again, these positive feedback loops playing all together, like where you have higher wages, you have people having a lot of money on their own because of the pandemic stimulus, you have supply chains that are kind of constrained, and it's all kind of feeding into the same beast of inflation. We're on the opposite side of that. Supply is fine, no longer has the constraints it had during the pandemic era, and on top of that, people no longer see the abundance of 2022. People are acting more in a more defensive manner. And what that tells you is that wages are more likely to stay flat. Okay, you're no longer, it's less likely to see wages rise significantly. That is at least just going off of the quits rate. And so, therefore, a second bout of inflation, as far as my personal view, I could very easily be wrong, is to be considered unlikely. Okay, and I'll say the same thing I said in my first video I made a month ago, is that the risk at this point is that while everyone is focused, like the Fed, on inflation, you're really at a point in the cycle where you should be worried about growth because of everything I just pointed out, like the quits rate being at cycle lows, the hiring rate is low, well below cycle highs, okay? And generally speaking, growth scares aren't born out of, when the hiring rate is, high as a low. Recessions and growth scares in general brew in this kind of area right here, where it slows down, where it kind of stalls. Okay, the level of change is the same, and that's what allows the worst case scenario to actually occur. And that leads me to another data point, like initial jobless claims. The reason why I think something like along the lines of, whenever I hear the economy is strong because initial jobless claims are low, is inherently flawed, because by the time initial jobless claims are breaking out, it's already too late. I've made an example of saying, I'm not going to have a shower until I smell like rotten eggs. If you're waiting that long, it's already too late. Okay, so again, just because the layoff cycle hasn't begun yet doesn't mean that there is an underlying weakness. Like, if you were to take a look at previous non-farm payroll prints, the bulk of hiring has come from things like healthcare and education, which are historically, there's always hiring in those sectors, okay? And generally speaking, whenever you're walking into a slowdown, that's what you see. You see all of the other sectors kind of be sluggish, and most of the hiring coming from sectors that aren't really, generating, healthy jobs. Okay, but again, this is just kind of to bring everything together and say that at this point, given where the quits rate is, and that is basically the survey, the real survey of how people are feeling, and given the fact that we also have other factors, which I'll speak and I'll touch on a bit, inflation is a problem, but is not the biggest problem at this point. We also had, just before I move on, we also had initial jobless claims coming at 220. And again, my expectation with this is that it'll slowly grind higher. And if we do actually see something worse come up, it'll probably break out. But that is something that I think will, if it'll happen, it'll happen around the summer. I think this is a developing story, which we'll have to go back and see in the summertime. Just before I move on to the S&P 500, I'll point out something else about inflation, which is, even though inflation is a problem, okay, because we are well above the famous 2% target, historically, inflation has the very bad habit of making itself be felt at the worst possible time. If you go back to 2008, for example, you'll see that in July of 2008, just before one of the worst crises in history, you had inflation come up at 5.6%. Okay, if you go back to the 2000 recession, you had inflation get sticky at around 3.5%. All right, just before the 2001 recession, and of course, you'll see what follows. If you look back at the 1990s, what you'll see is that inflation was at 6.3 at that time. Then you had the 1990s recession, and the rest is history. Now, just to make a stronger case for why it pays to look at economic data on the growth side of things, given where we are in the cycle, and that is also why, looking at the S&P 500, I've been skeptical of any possible news. I mean, possible sustained rallies. Okay, I have made the case for, at the very least, a relief rally. But even if we were to see a relief rally, I would fade it, because on top of the fact that we have a slowing trend, we also have further things affecting the market currently. And that is what Trump and Scott Bessent are signaling, and what they're really doing. So you really have two things that are acting as a headwind for things like the S&P 500 right now. You have tariff uncertainty. And as far as the tariffs are concerned, businesses in general, yes, if they could avoid tariffs all at once, altogether, it would be probably the best case scenario. But if they really had to choose between having tariffs, not knowing, or again, really, if they had to choose between not knowing if they have tariffs or having tariffs, at the very least, I think that everyone would choose having tariffs, because again, it would just be a certainty. You would know at that point in which kind of regime you're acting. If you don't know if you have tariffs, like what you've seen in the past month and a half, like one day you'll see Trump talk about, massive tariffs, then you'll have one of his minions come out and say the complete opposite. like, oh, we'll cut a deal and maybe there won't be, tariffs won't be that bad. But then a week later, you have, you know, more saber rattling. And so you never know you know, what to believe. And that is what is really detrimental to business, not knowing what your future is going to be like, because you really can't plan ahead. So that's tariff uncertainty. Number two, layoffs at the government sector, which is resulting in overall fiscal tightening. Of course, this isn't a short term story. You won't feel the effects now. And that is also why I often talk about the summertime. You really have to give all of these things that that they're doing at the government level to play out. Okay. And I think that the summertime will be kind of your first checkpoint to see how much the damage that is being done now. I mean, what is the magnitude of the damage? Let's see what the effects of it are. But in any case, governments layoffs at the government level, the way you have to really think about it isn't so much in relation to initial jobless claims, which is the direct effect. It's more the indirect effects that you have to worry about. Meaning, first off, a salary that gets cut is a salary that isn't circulating in the economy anymore. So just think that, if you have restaurants, you have offices, you have any kind of service that is being offered to people that previously had that salary, they don't have access to that income anymore, okay, because of the money that those people that was previously spent. Also, you see things like I'm pretty sure it was Anna Wong, chief U.S. economist at Bloomberg, if I'm not mistaken, talk about how for every government employee you have something like two private contractors, okay, that potentially lose a job because of, again, if a government employee has to work with a number of people, okay, and if they get affected, the people they're connected to get affected as well. And again, that is something that will act as a headwind going forward if these things do continue. And as far as the news is concerned, it just gets reinforced day after day. On top of that, you have a third thing, which is kind of a bonus, really, but I still think it's worthwhile to look at, which is the yen. Whenever you see the yen strengthen against the dollar, that is usually another risk off signal. Okay. And one way you can visualize that is if you overlay the 30-year yield. Okay. You can see an immediate correlation between the two. Whenever you see, let me just take the volume off. Whenever you see significant strength, you see risk off sentiment. And whenever you see the yen losing strength, so weakening, you see a risk on sentiment. Okay. And again, this plays into the yen carry trade. I made a separate video about it, and I'll leave the link in the description if you feel like watching it. And I think it pays to watch this as well. Going back to the S&P 500 though, I've reasoned in my previous videos that, and as other things I mentioned in this video right here, that as long as you have these headwinds, you're more likely to see more of the same. Okay. Meaning that as long as you have tariffs and tariff uncertainty be a possibility, like it is now, as long as you have the indication that you're going to have some kind of fiscal tightening. Okay, so we already saw a hiring freeze get announced. At the government level, we've seen some job cuts. If those factors continue to linger, you're more likely to see more of the same. meaning bleed. And as long as they stay, any relief rally, again, I've said it, quite a few times now. Whenever it comes, I would expect to get back to at least the bull market support band. But what you really have to look at while that rally, if it happens, what you'd have to keep an eye on is the economic data, because at the end of the day, what we're really being held hostage by at this point is the economic data. Say we have a rally after, let's say, the end of March, okay? So after the 20th or something like that. Say post FOMC we have a rally for whatever reason. If we get to the beginning of April and we're around the bull market support band, watch the non-farm payroll print, okay? Watch for the PMIs and watch for initial jobless claims. As I've given my kind of the way I kind of look at the initial jobless claims, it seems to me that the break-even point is between 215 and 220. Okay. So whenever you're below 215, it's an indication that you could possibly see the unemployment rate come in lower, and if you have initial jobless claims stay above 220, there is a case to be made that the unemployment rate will be higher. So keep an eye on initial jobless claims. We don't currently have a forecast yet for next month, for next week's read. Maybe let me see if this makes it. No difference at all. But in any case, pay attention to the economic data, because like what we saw in the PMIs come in for February was a shift from optimism to really pessimism. Okay. And what you want to see is if February was a fluke, so a one-off, or if it's the beginning of a new trend, something that is more consistent with last summer's data. If you see the PMIs come in negative, if you see non-farm payroll print surprise to the downside with potentially the unemployment rate going up, okay, at that point, any kind of strength could be, you could get the rug pulled from under your feet with the enthusiasm. So again, this isn't a story, I think, at this point about technicals, about fib retracements, about bear flags and bull flags and things like that. It's really a story, as far as I'm concerned, of the data. Given what, again, Trump and Besson have signaled as well, if you do have weakness in the data, given also the high expectations that we had at the beginning of the year, okay, if you have surprises to the downside, that'll just fuel more of this of the bleed. And the only way this bleed stops, in my opinion, is if you see something like Trump comes out and he says tariff is no longer my favorite word in the dictionary, and we're going to start talking about tax cuts or stimulus, something to stimulate the economy. If you have those things come out, then of course it's risk on, and we can start talking about bear flags and technicals and all of that. As long as this is the regime, it's a matter of where is the economic data coming out, okay? And just to touch quickly on why, again, just to reinforce what I'm saying, is that what we have right here is really not so much a pricing in of a recession. It's really just having to reprice things as the exceptional expectation, if that's how you want to put it, that we had at the beginning of the year, where you had optimism on growth. So you had growth being, kind of a given. and pessimism on inflation, we're at a point where we're starting to have to kind of flip the two things. Okay, we're not considering a recession at this point. As I pointed out in one of my previous videos, if we were considering a recession, you'd see the 30-year well below 4%. We are still at quite elevated levels if in the context of history. Okay, we've seen 460 on the 30-year in September of 2023, and we have that level right now without the strength and growth that we had in 2023. So again, we're not pricing in a recession necessarily, and I'll move on to TLT in a minute. What we're really having to do at this point is saying, hold on, maybe we were too optimistic on growth. Okay, this is just a reconsideration of the high expectations on growth, that we had on growth at the beginning of the year. Okay, if we were to price in a recession, I think that the move would be much more dramatic, and that leads me to the bond market. So we really had 2 weeks of kind of the TLT not doing much at all. Okay, we had the breakout on the week of February 24th. And ever since that, we've kind of been hugging the bull market support band. Now, I've mentioned a few times that I wouldn't be surprised by a retest of this trend line we broke out of on the end of February. And it could also come on the back of, say, the FOMC, something that Powell says that could kind of move things in the short term. But as far as I'm concerned, those would be short-term fluctuations. The only way you get something deeper is, again, if you have economic data suppressed at the upside again. So say a non-farm payroll print that gives you something like 300K. Okay. If you have that, you could also revisit this previous bottom at $82.76, which is something that TLT usually historically does. So the reason why I still have this white line that corresponds to the October 2023 low is that, as I've pointed out in previous videos, TLT has a history of putting in double bottoms, but you really have two kinds of double bottoms. Okay, you have the 2007 style double bottom where you have a sweep of the low, so a slightly lower low, or the 2010 double bottom where you have TLT put in a slightly higher high. As long as we stay above these levels, it makes the case, a stronger case for this to be something more akin to 2010. If again we see something more, more economic optimism, you could, see possibly TLT go back to the $80 range, something like that. Although, again, given the headwinds we have on growth, and given the fact that we were pricing in, probably peak economic optimism at the beginning of January with that non-farm payroll print, I think, and given also where initial jobless claims, just as a bonus there, where what usually happens with initial jobless claims is that they bottom in January and then you have a slow grind higher as you move towards the summer, which is kind of seeing the beginning of that now. I wouldn't be surprised at all if this is just like, currently holding support at the bull market support band and then just going on its merry way. And then we'll just have to assess how things are holding up in the summer. Again, I don't think we're going to see anything too dramatic until the summer. I think that anywhere between May and September will be an interesting time for the bond market. While we're on the topic of the bond market, what I would bring up is the Russell 2000. And you might say, why are you bringing up the bond market for the Russell 2000? And I talked about this in my in the yen carry trade video. And small caps, as argued by, if you follow him, Michael Guyad on X, he's quite vocal about this, and many other people probably do a much better job than I will in explaining this. But what you have is kind of a divergence between the small cap index in the Russell 2000 and something like credit spreads. Okay, so even today, if I'm not mistaken, even today you see a breakout from this trend line, which of course this is dubious at best. But again, this is just kind of to point out that we've had this kind of lower high structure. We currently see credit spreads break out. Now, what are credit spreads? They're basically the premium over the risk-free rate that you would ask a triple B rated, I think that's the rating of a triple B rated company, again, to provide them credit. Okay, so the idea is if the 10-year is offering me 4.3%, the market is currently asking for a 3.4% extra on top of that. Okay, to compensate for the risk you're taking, for the extra risk you're taking, to loan out money to a company that isn't as again, you have like a bankruptcy risk and so on and so forth that you don't have with the risk-free rate. Now, we do see the beginning of a breakout, okay, which is significant, but the divergence people were pointing out, and which I also pointed out in my yen carry trade video, is that credit spreads, well, just ignore this move right here, this breakout. Credit spreads up until the end of February were at cycle lows that weren't seen since ever, probably. I mean, I really have to go back here quite a bit. Okay, I'm glad to see it wasn't ever, but say really 2007. Okay, now what does that tell you? It tells you that perceived risk for bond issuance, for these companies, was quite low. And the reason for that is, if you're asking a lower premium on top of the risk-free rate, what you're really saying is that I think that there's low risk associated with loaning money to these companies. So I'm not going to ask for extra compensation. But if that is true, if that were true, okay, if credit spreads were right at the beginning of February, at the end of February, then why wasn't the Russell 2000 really rallying at that point? In general, if you were to see credit spreads be cycle lows and continue to put in lower lows, meaning that perceived bankruptcy risk is low, then why haven't small caps performed better? That is really the question, because again, if you look at the 2021 high, now if you measure it to today's price action, it's nearly a 20% drop, okay, if you consider the low. At best, small caps at the beginning of December got to parity with the 2021 high. A time during which you had the S&P had something like a 30% rally from the 2021 high. Okay, everything had a great time except small caps. Okay, so really, what you have is a situation where someone is lying, because only one can be correct. Only one can be telling the truth. If credit spreads are low and they're telling the truth, then the Russell 2000 should be sky high, because again, the Russell 2000 is kind of the reflection of the companies that are asking for this, for credit. So again, if the stocks of the companies have low bankruptcy risks, then they should be skyrocketing. But it isn't what we've seen. We've seen them underperform in the last few years. On the flip side, if the Russell 2000 is correct in underperforming, then that simply means that credit spreads are misplaced and they have to be much, much higher because perceived risk isn't low, it's high. So they have no business being here. And so they have to break out. Potentially, we've seen this, the beginning of it, which generally speaking, on the economic side of things, isn't a positive sign. Whenever you see credit spreads really explode, that is associated with times of stress and general risk-off sentiment. Okay, so you see that happen in 2007, 2008, where we actually went up to the 30s, I think, or lower 20s. You saw that happen in the 2000 recession. You saw that happen during COVID. And well, we'll see what happens here with credit spreads. And you also saw another way you can see this is HYG, which is the high yield corporate bond ETF. And you saw the high yield index sell off yesterday, and you had TLT rally. Okay, so again, playing into this risk off theme, it's all things you have to consider really, and you have to put them into the right context. And again, it's a lot of things to consider. What I'm really interested in isn't so much the short term fluctuations. As I said previously, we could have a retest of this trend line. And we could also go further down, although personally I think it's unlikely, simply because directionally from this point on, just by looking at history, and given the fact that the starting point for the economy is much weaker than it was, is at the very least weaker than it was last year, directionally things are headed towards a slowdown. And really what you have to try and figure out from here to the summer, in my opinion, is how much damage is being done. Okay, and how far will it push? Will it weigh? How much will it weigh on the economy? Will it weigh a lot? If you think it'll weigh a lot, then you'll probably want to be bullish on bonds. I personally bullish on bonds for the simple reason that, on top of everything I've mentioned, the best place to short bonds isn't at the bottom, in my opinion. Of course, it could very well just puke down. But at that point, if we're down here, we don't really want to live in that kind of a world, I think. But in any case, just by looking at history and what happens in history, I think that this is risk reward wise, I think it's a much better place to be optimistic on bonds than pessimistic. And just to bring everything together, if you look at where things stand, like we had the PMI report, again, this is just 1 month. What really matters is the trend. So even last month's things like the non-farm payroll report we had last month, which was, to quote Chernobyl, not great, not terrible. We did have a miss, which I was expecting. We did have an increase on the unemployment rate, but directionally, as you can also see it, you can also visualize it like this. We do have generally things cooling off, okay, and unless you have an external shock, like say the Fed starting QE, okay, if the Fed starts something massive like asset buying programs like we saw in during the COVID era. Okay. If we were to see something like this, then okay, you'd have to reevaluate things. If you saw zero interest rate policy return, you'd have to reevaluate things. If you saw Trump come out and say no more tariffs, tax cuts, then you have to reevaluate things. But as long as the status quo remains, directionally, I wouldn't be too bothered about short-term fluctuations. Okay, more of the same. And what is more of the same? Bonds having a bid, catching a bid. Nothing too dramatic until the summer, in my opinion. And stocks underperforming. And even if we do get a relief rally, whenever it comes, as I said in my previous videos, I wouldn't be a buyer of that rally. I would tend to fade it for the simple reason that again, as long as we're acting in this kind of a scenario, expect more of the same. Okay. If we do get a rally, as I said before, what you really have to pay attention is it coming on the back of things changing? Okay. Is it happening because things are structurally changing? So you have 300 basis points of rate cuts from the Fed. Do we have Trump talking back, tariff talk, and and start to focus more on the growth side of things, so tax cuts, stimulus? Then you could argue that it has legs to stand on. But if you see a rally and nothing's changed, then expect more of the same, which is what we've seen ever since the end of February. I think I'll leave it at that. The only really other thing you could mention is Bitcoin, but again, I put Bitcoin in the same basket as the S&P 500. Really, it isn't a risk-off asset; it's a risk-on asset. And as long as the status quo exists, as long as we're in the status quo, expect more of the same. And crypto in general is far more sensitive than stocks. Like if stocks have a 10% drop, as we've seen, what will happen to crypto is that multiplied by X amount. So we're already down 30% on the highs. So again, I'll leave it at that. Keep an eye on credit spreads, keep an eye on the bond market, keep an eye on generally speaking, on economic data, which I think is the phase we're in. Okay, we're in economic data dominance, if you really want to put a name on it, because that is what will determine where things are headed. If you like this kind of content, consider leaving a like, and I'll see you next time. Bye.